Course Overview. Investing in distressed properties. Investing in foreclosures and distressed properties offers unique opportunities for significant returns, but it also comes with inherent complexities and risks. This course will guide you through the intricate world of acquiring properties that are often sold below market value due to financial hardship or legal issues. Understanding the various stages of foreclosure and the different types of distressed assets is crucial for any aspiring investor in this niche market. We will explore the benefits, such as potential for high equity gains, and also address the challenges, including extensive due diligence and legal hurdles. Our goal is to equip you with the knowledge and strategies necessary to navigate these investments successfully, from initial identification to profitable exit. A distressed property is generally defined as a property that is under some form of financial or legal duress, often leading to its sale at a reduced price. These can include homes facing foreclosure, properties owned by banks, REOs, or those sold in short sales where the sale price is less than the outstanding mortgage balance. Investors are drawn to these properties because of the potential to purchase assets at a discount, allowing for greater profit margins after renovation and resale or rental. However, successful investing requires a deep understanding of market conditions, legal processes, and property valuation techniques. This course will cover all these aspects, ensuring you are well prepared for this challenging yet rewarding field. Understanding foreclosure, the basics. Foreclosure is a legal process by which a lender attempts to recover the balance of a loan from a borrower who has defaulted on their mortgage payments. This process involves forcing the sale of the asset used as collateral for the loan, typically real estate. The specific procedures for foreclosure vary significantly by state, with some states favoring judicial foreclosure, which involves court intervention, and others allowing non-judicial foreclosure, which proceeds outside of court. Understanding these differences is paramount for investors, as they dictate the timeline, legal requirements, and potential opportunities for intervention. The ultimate goal of the lender is to recoup their losses, and the property owner faces the loss of their home. The foreclosure process typically begins after a borrower misses several mortgage payments, leading the lender to issue a notice of default. This initial notice formally informs the borrower of their delinquency and the lender's intent to foreclose if the default is not cured. Following this, various legal steps are taken, depending on the state's laws, which can include filing a lawsuit or publishing a notice of sale. Each stage presents different opportunities for investors to acquire the property, either directly from the homeowner in pre-foreclosure, at a public auction, or from the bank after the auction. Navigating these stages requires careful attention to detail and a clear understanding of legal timelines. Types of distressed properties. Distressed properties encompass a range of real estate assets beyond just foreclosures, each presenting unique investment characteristics and challenges. Understanding these distinctions is crucial for tailoring your investment strategy and due diligence efforts. Pre-foreclosures, for instance, are properties where the homeowner has received a notice of default, but the foreclosure sale has not yet occurred, offering a window for direct negotiation. Short sales involve properties where the lender agrees to accept a mortgage payoff amount less than what is owed, typically due to the homeowner's financial hardship and the property's depreciated value. These require lender approval and can be lengthy processes. Bank-owned properties, also known as real estate-owned (REO), are properties that have gone through the foreclosure process and reverted to the lender because no one purchased them at auction. These properties are often sold as is and may require significant repairs, but they can also offer more straightforward transaction processes compared to pre-foreclosures or short sales. Other distressed assets include properties with tax liens, probate properties, or those involved in bankruptcy proceedings. Each type demands a specific approach to research, negotiation, and financing, highlighting the importance of a comprehensive understanding of the distressed property landscape for successful investing. Why invest in foreclosures? Benefits. Investing in foreclosures and distressed properties offers several compelling benefits that attract savvy real estate investors. The primary advantage is the potential to acquire properties significantly below market value, creating instant equity. This discount provides a larger margin for profit whether the investor plans to renovate and resell, flip, or hold the property for rental income. A lower acquisition cost also reduces the overall investment risk, as there is more room for unexpected repair expenses or market fluctuations. Furthermore, the distressed nature of these sales often means less competition from traditional buyers, who may be deterred by the complexities involved, giving experienced investors an edge. Another significant benefit is the potential for accelerated equity growth through forced depreciation. By investing in a property that requires repairs and improvements, investors can substantially increase its value through strategic renovations. This value-add approach allows for greater control over the property's appreciation compared to simply waiting for market forces. Additionally, the sheer volume of distressed properties, especially during economic downturns, can provide a consistent supply of investment opportunities. This niche market allows investors to specialize and develop expertise, building a robust portfolio with potentially higher returns than conventional real estate investments. Risks and challenges of distressed investing. While the potential for profit in distressed property investing is attractive, it is crucial to acknowledge and prepare for the significant risks and challenges involved. One major hurdle is the as-is condition of many distressed properties, meaning they are sold without warranties or guarantees regarding their state. This often translates to unforeseen repair costs, which can quickly erode profit margins if not accurately estimated during due diligence. Additionally, properties acquired through auction may not allow for prior inspection, forcing investors to bid blindly on assets with potentially severe structural or environmental issues. Legal complexities, such as junior liens or title defects, can also arise, leading to costly legal battles and delays. Another challenge is the emotional and often sensitive nature of these transactions, as they involve individuals facing financial hardship. This can complicate negotiations, particularly in pre-foreclosure scenarios. Market volatility also poses a risk. A downturn in the real estate market can diminish the value of a distressed property even after renovation, making it difficult to recoup the investment. Furthermore, the specialized knowledge required to navigate the legal, financial, and logistical aspects of distressed investing can be a barrier for inexperienced individuals. Thorough research, a strong support team, and a conservative financial approach are essential to mitigate these inherent risks. Pre-foreclosure. Notice of default. The pre-foreclosure stage is the initial phase of the foreclosure process, beginning when a homeowner misses several mortgage payments, and the lender issues a notice of default, NOD. This notice formally informs the borrower that they are in default and specifies the amount owed to cure the default. The NOD is a critical document for investors because it signals an impending foreclosure sale, creating an opportunity to intervene before the property goes to auction. During this period, the homeowner still retains ownership and has a chance to resolve the delinquency, often by selling the property or refinancing the loan. For investors, this stage offers the best chance to negotiate directly with the homeowner. For investors, the pre-foreclosure period is often the most advantageous time to acquire a distressed property. By contacting homeowners directly, investors can offer solutions that benefit both parties, such as a quick cash sale that allows the homeowner to avoid foreclosure and its negative impact on their credit. This approach requires sensitivity and a problem-solving mindset, as homeowners are typically under significant stress. Understanding the specific timelines and legal requirements for filing an NOD in your state is crucial, as these details dictate how long the pre-foreclosure window remains open. Successful engagement at this stage can lead to mutually beneficial outcomes and potentially better deals for investors. Lis pendens and judicial foreclosure. In states that follow judicial foreclosure, the process formally begins when the lender files a lawsuit in court against the borrower. This legal action is typically accompanied by a lis pendens, which is a public notice filed with the county recorder's office. Lis pendens, Latin for suit pending, serves as a warning to potential buyers or lenders that the property is subject to a pending lawsuit that could affect its title. This notice makes it difficult for the homeowner to sell or refinance the property without resolving the underlying legal issue. For investors, a lis pendens signals that the property is officially in the judicial foreclosure pipeline and requires careful monitoring. Judicial foreclosure involves several steps, including the filing of a complaint, service of process to the borrower, and often a court hearing where a judge reviews the case. If the court finds in favor of the lender, it will issue a judgment of foreclosure, ordering the property to be sold at a public auction. This process can be lengthy, often taking several months or even years, depending on court backlogs and state laws. While longer, judicial foreclosures provide more transparency through public court records, which can be beneficial for investors conducting due diligence. Understanding the specific legal procedures in judicial states is crucial for accurately assessing timelines and potential investment risks. Non-judicial foreclosure, power of sale. In contrast to judicial foreclosure, non-judicial foreclosure, also known as power of sale foreclosure, allows lenders to foreclose on a property without court intervention. This process is typically faster and less expensive for lenders, making it a common method in many states. The power of sale clause is usually included in the original mortgage or deed of trust, granting the lender the right to sell the property if the borrower defaults. Instead of filing a lawsuit, the lender or a trustee followed specific statutory procedures which primarily involve providing public notice of the default and the upcoming sale. This streamlined process means a shorter window for homeowners to cure the default and for investors to intervene. The non-judicial foreclosure process generally begins with the recording of a notice of default, similar to judicial foreclosure. However, instead of a lawsuit, the next step is often a notice of trustee sale, which specifies the date, time, and location of the public auction. These notices are typically published in local newspapers and posted on the property itself. Investors must be diligent in monitoring these public records and publications to identify opportunities. The compressed timeline of non-judicial foreclosures means that investors need to act quickly, conduct rapid due diligence, and be prepared to bid at auction with limited information. Understanding the specific power of sale statutes in your target state is essential for successful non-judicial foreclosure investing. Foreclosure auction, trustee sales. Foreclosure auctions, often referred to as trustee sales, are public events where properties in default are sold to the highest bidder to satisfy the outstanding debt. These auctions are typically held in public places, such as courthouse steps or designated government buildings. Investors attending these auctions must be prepared to act quickly and decisively, as properties are sold as is and often require immediate payment in cash or certified funds. The bidding process can be fast-paced, and it's crucial to have a maximum bid established beforehand, based on thorough due diligence and repair estimates. Winning a bid at a trustee sale can lead to significant equity, but it also carries substantial risks due to the limited opportunity for inspection. Before attending an auction, investors must conduct as much research as possible, including title searches to identify any senior liens or encumbrances that would remain on the property after the sale. It is important to remember that in many states, only junior liens are extinguished by a foreclosure sale. Understanding the specific rules and regulations of the auction, including registration requirements and payment methods, is also critical. While the potential for high returns is a major draw, the lack of property inspection, the as-is condition, and the immediate payment requirement make foreclosure auctions a high-risk, high-reward investment strategy best suited for experienced investors with readily available capital. REO properties, bank-owned assets, real estate owned. REO properties are those that have completed the foreclosure process and reverted to the lender. typically a bank, because no successful bid was made at the foreclosure auction. Unlike properties sold at auction, REOs are owned by the bank, which means the title is usually clear of junior liens, and the bank often handles the eviction of previous occupants. This makes REO properties generally less risky from a legal standpoint compared to auction properties. Banks are motivated to sell these assets quickly to recover their losses, often listing them through real estate agents specializing in REO sales. This provides a more traditional purchasing process, albeit with some unique considerations. When investing in REO properties, buyers typically negotiate directly with the bank or its designated agent. While banks often sell properties as is, they may be more open to minor repairs or price adjustments than at auction. Investors can also usually conduct inspections, which is a significant advantage over auction purchases. However, banks are not in the business of owning real estate, so they may be less responsive or slower in negotiations. It is crucial to have a clear understanding of the bank's selling process, which can vary, and to be prepared for potentially lengthy closing periods. Despite these challenges, REO properties can offer excellent investment opportunities with reduced legal complexities. Sources for pre-foreclosure leads. Identifying pre-foreclosure leads is a critical first step for investors seeking to acquire distressed properties before they go to auction. These leads represent homeowners who have received a notice of default but still retain ownership, offering a window for direct negotiation. One of the most common sources for these leads is public records, as the notice of default is typically filed with the county recorder's office. Investors can regularly check these public filings either in person or through online county databases to identify properties entering the pre-foreclosure stage. This method requires diligence and consistent effort to stay updated on new filings. Beyond public records, several other avenues can provide valuable pre-foreclosure leads. Networking with real estate attorneys, mortgage brokers, and other real estate professionals can yield referrals, as these individuals often encounter homeowners facing financial distress. Direct marketing efforts, such as sending letters or postcards to homeowners who have missed mortgage payments, can also be effective, though they require a sensitive approach. Online services and data providers specialize in compiling and selling pre-foreclosure lists, offering a more convenient but often more costly option. Combining multiple lead generation strategies can maximize your chances of finding profitable pre-foreclosure opportunities. Public records and online databases. Public records are an invaluable, often free, resource for identifying distressed properties, particularly those in pre-foreclosure or with tax liens. The county recorder's or clerk's office is the primary repository for documents like notices of default, lis pendens, and tax lien filings. Many counties now offer online access to these records, allowing investors to search for properties by owner name, address, or parcel number from the convenience of their home or office. While these online databases can be incredibly efficient, they may require some familiarity with legal terminology and search parameters. It is essential to understand the specific website navigation and search functions for your target counties. Beyond county-specific websites, several commercial online databases and subscription services specialize in aggregating and organizing distressed property data. These platforms often provide more user-friendly interfaces, advanced search filters, and compiled lists of pre-foreclosures, auctions, and REOs. While these services come with a cost, they can save significant time and effort, especially for investors operating in multiple counties or states. When utilizing any database, whether public or commercial, always cross-reference information and verify details to ensure accuracy. Relying solely on one source without verification can lead to costly mistakes in distressed property investing. Working with real estate agents. Collaborating with experienced real estate agents can be a highly effective strategy for finding distressed properties, particularly REOs and short sales. Many agents specialize in these types of transactions, and have established relationships with banks and asset managers. These agents often receive early access to REO listings before they hit the broader market, giving investors a competitive advantage. They can also help navigate the complex negotiation processes with lenders, which differ significantly from traditional home sales. When selecting an agent, look for someone with a proven track record in distressed property sales and a deep understanding of the local market dynamics. Their expertise can be invaluable in identifying suitable properties and streamlining the acquisition process. A good agent can also assist with short sale negotiations, which involve convincing a lender to accept less than the outstanding mortgage balance. This process requires extensive paperwork and persistent communication with the bank, tasks an experienced agent can manage efficiently. Furthermore, agents can provide access to the multiple listing service, MLS, where some distressed properties, especially REOs, are listed. While agents typically earn a commission, the value they add in terms of market access, negotiation skills, and process management often outweighs the cost. Building strong relationships with a network of specialized agents can significantly enhance an investor's ability to source and acquire profitable distressed assets. Networking and direct marketing. Networking within the real estate community is a powerful, yet often overlooked strategy for uncovering distressed property opportunities. Building relationships with other investors, wholesalers, attorneys, probate specialists, and contractors can lead to valuable referrals and off-market deals. These professionals often have early access to information about properties in distress before they become public knowledge. Attending local Real Estate Investment Association (REIA) meetings, industry conferences, and online forums provides excellent platforms for making these connections. Sharing your investment criteria and demonstrating your ability to close deals quickly can position you as a go-to buyer for distressed property leads. Direct marketing involves proactively reaching out to potential sellers, particularly homeowners in pre-foreclosure. This can include sending targeted mailers, postcards, or even door-knocking with sensitivity and respect. While direct marketing requires a significant investment of time and resources, it can yield highly motivated sellers who are eager to avoid foreclosure and are more open to negotiation. Crafting a compelling message that offers a solution to their financial problems, rather than just a lowball offer, is crucial for success. Combining networking with direct marketing creates a robust lead generation system, increasing your chances of finding profitable distressed property investments. Government agencies and websites. Government agencies and their associated websites are often overlooked but valuable sources for distressed property listings. The U.S. Department of Housing and Urban Development, HUD, is a prime example, offering HUD-owned homes that have been foreclosed upon with FHA-insured mortgages. These properties are sold through an online bidding process, often at competitive prices, and are initially offered to owner-occupant buyers before becoming available to investors. Similarly, the Department of Veterans Affairs, VA, sells VA-acquired properties, which are homes that have gone through foreclosure on VA-guaranteed loans. These websites provide detailed property information and clear bidding instructions, making them accessible resources for investors. Beyond HUD and VA, other government entities, such as the IRS, Internal Revenue Service, for tax-forfeited properties, and local county governments for tax lien sales, also offer distressed real estate opportunities. Each agency has its own specific procedures, bidding platforms, and eligibility requirements that investors must understand. While these properties can represent excellent deals, they often come with their own set of complexities, such as potential liens or required repairs. Diligent research on each agency's website and a thorough understanding of their processes are essential for successfully acquiring properties from government sources. Property research and title search. Thorough property research and a comprehensive title search are absolutely critical steps in distressed property investing, often more so than with traditional real estate. Since many distressed properties are sold as is and may have complex legal histories. Understanding every aspect of the property's past is paramount. Property research involves investigating the physical characteristics, zoning regulations, permit history, and any known environmental issues. This can be done through county planning departments, building departments, and online mapping tools. The goal is to uncover any hidden problems that could significantly impact the property's value or your ability to develop it. A title search is specifically designed to uncover any liens, encumbrances, or defects that could affect the property's clear ownership. This includes checking for outstanding mortgages, tax liens, mechanics liens, judgments, and easements. In foreclosure sales, especially at auction, it is crucial to understand which liens will be extinguished by the sale and which will remain. A clear title is essential for obtaining financing and for the eventual resale of the property. Engaging a reputable title company or real estate attorney to conduct a professional title search is highly recommended to avoid inheriting costly legal issues. This due diligence protects your investment and ensures a smooth transaction. Assessing property condition and repairs. Accurately assessing the physical condition of a distressed property is one of the most challenging yet crucial aspects of investing. Since many properties are sold as is and may have been neglected for an extended period, they often require significant repairs. Investors must develop a keen eye for identifying both obvious and hidden defects, ranging from structural damage, roof issues, and plumbing problems to electrical faults and pest infestations. A thorough inspection, ideally by a licensed professional, is essential to uncover these issues and estimate the scope of necessary renovations. Without a clear understanding of the property's condition, it's impossible to accurately project repair costs and potential profitability. Beyond identifying problems, investors need to estimate the cost of repairs accurately. This involves getting quotes from contractors or having a strong understanding of construction costs for various trades. It's always wise to budget for unexpected expenses, as distressed properties often reveal new issues once renovation begins. Consider the after-repair value, ARV, of the property and ensure that the total acquisition cost plus renovation expenses will still leave a healthy profit margin. Prioritize repairs that add the most value and are essential for safety and habitability. A detailed repair plan and budget are indispensable tools for successful distressed property investing, preventing cost overruns and ensuring a profitable outcome. Comparative Market Analysis, CMA. A comparative market analysis, CMA, is a crucial tool for accurately valuing distressed properties, helping investors determine a property's current market value and its potential after-repair value, ARV. A CMA involves analyzing recently sold properties, comparables or comps, that are similar in size, style, age, and location to the subject property. By comparing these properties, investors can estimate what a renovated distressed property could sell for in the current market. This analysis is particularly vital for distressed properties, as their current condition often does not reflect their true market potential once repaired. It helps set a realistic maximum offer price and project potential profit margins. When conducting a CMA for distressed properties, it's important to adjust for differences between the comparables and the subject property, such as lot size, number of bedrooms, bathrooms, and amenities. Focus on comps that have sold within the last 3 to 6 months and are within a close proximity to the subject property. For ARV, look for recently renovated homes in the area that are similar to your planned improvements. Real estate agents can be valuable resources for CMAs, as they have access to MLS data and local market insights. A well-executed CMA provides the foundation for sound investment decisions, ensuring that you don't overpay for a distressed asset and can achieve your desired return on investment. Estimating renovation costs accurately. Estimating renovation costs is paramount for successful distressed property investing, as these expenses directly impact your profit margins. A comprehensive estimate requires a detailed breakdown of all necessary repairs and upgrades, from major structural work to cosmetic finishes. Start by categorizing repairs into essential, example, roof, foundation, plumbing, electrical, and cosmetic, example, paint, flooring, fixtures. Obtain multiple bids from reputable contractors for larger projects, and for smaller tasks, use reliable cost guides or your own experience. Always factor in permits, inspections, and potential unforeseen issues which are common in older or neglected properties. Overlooking any significant cost can quickly turn a profitable deal into a financial loss. Beyond the direct costs of materials and labor, remember to include soft costs such as architectural fees, engineering reports, and utility hookups. Also, account for holding costs during the renovation period, including property taxes, insurance, and utilities. A contingency fund, typically 10 to 20% of the total renovation budget, is absolutely essential for distressed properties to cover unexpected problems. Without a robust and conservative renovation budget, investors risk running out of capital or exceeding their after-repair value (ARV) threshold. Detailed planning and careful estimation are the cornerstones of managing renovation expenses effectively and ensuring a profitable investment. Calculating potential profitability. Calculating the potential profitability of a distressed property investment is the ultimate determinant of whether a deal is worth pursuing. This involves a comprehensive financial analysis that integrates all acquisition costs, renovation expenses, holding costs, and estimated selling costs. The core calculation often revolves around the maximum allowable offer, MAO, which is derived from the after-repair value, ARV, minus all estimated costs and your desired profit margin. A common formula is NAO equals ARV minus renovation costs plus holding costs plus selling costs plus desired profit. This formula ensures that even after all expenses, you achieve your target return. It is crucial to be conservative with your estimates, particularly for renovation costs and the ARV, as unexpected issues or market shifts can quickly erode profits. Always factor in a contingency fund for unforeseen expenses. Consider different exit strategies: flip, rent, hold, and calculate profitability for each, as this can influence your offer price and renovation scope. A deal that doesn't meet your minimum profitability threshold should generally be passed on, regardless of how attractive the initial purchase price might seem. Diligent financial modeling and a clear understanding of your desired returns are essential for making sound investment decisions in the distressed property market. Funding options for distressed properties. Securing appropriate financing for distressed properties can be more challenging than for traditional real estate, as many conventional lenders are hesitant to finance properties in poor condition or those acquired through non-traditional means like auctions. Therefore, investors often need to explore alternative funding options. Cash is king in distressed property investing, offering the fastest closing times and the strongest negotiating power, especially in pre-foreclosure or auction scenarios. However, not all investors have ready access to large sums of cash, necessitating other creative solutions. Understanding the various financing avenues available is crucial for successfully acquiring these unique assets. Beyond personal cash, common funding options include hard money loans, private money loans, and sometimes even seller financing in pre-foreclosure situations. Hard money lenders are private individuals or companies that provide short-term, asset-based loans, typically at higher interest rates, but with faster approval processes and less stringent credit requirements. Private money loans come from individuals or small groups of investors who lend based on relationships and the deal's merits. While these alternative financing methods can be more expensive, their flexibility and speed are often essential for capitalizing on distressed property opportunities. Traditional bank loans are generally reserved for REO properties in better condition or after initial renovations are complete. Cash offers and hard money loans. Cash offers are the most powerful tool an investor can wield when acquiring distressed properties, A cash offer eliminates financing contingencies, significantly speeds up the closing process, and reduces the risk of the deal falling through. This makes cash buyers highly attractive to motivated sellers in pre-foreclosure and to banks selling REOs, often allowing for deeper discounts. At foreclosure auctions, cash or certified funds are typically the only accepted payment methods, making cash a prerequisite for participation. While not every investor has access to substantial cash reserves, understanding its leverage is key to appreciating its value in this market. For investors who need to move quickly but lack sufficient cash, hard money loans are a popular alternative. These are short-term, non-conforming loans provided by private lenders, typically secured by the real estate itself rather than the borrower's creditworthiness. Hard money lenders focus on the asset's after-repair value, ARV, and the investor's exit strategy. While interest rates are higher, often 8 to 15%, and fees can be substantial. Hard money loans can be approved and funded in a matter of days, allowing investors to close on distressed properties quickly. They are ideal for fix and flip projects, where the property will be sold or refinanced within a short time frame, typically 6 to 18 months. Creative financing strategies. Beyond traditional and hard money loans, creative financing strategies can be instrumental for investors looking to acquire distressed properties with limited capital or in unique situations. One such strategy is seller financing, where the homeowner acts as the bank, carrying the mortgage for the buyer. This is most common in pre-foreclosure scenarios, where a homeowner is highly motivated to sell quickly to avoid foreclosure and may be willing to accept payments over time. Seller financing can offer more flexible terms, lower interest rates, and reduced closing costs compared to conventional loans, making it an attractive option for both parties. Another creative approach involves subject-to investing, where an investor takes over the existing mortgage payments without formally assuming the loan. This can be beneficial if the existing loan has favorable terms or a low interest rate. However, it carries risks, including the due on sale clause, which could allow the lender to call the entire loan due. Lease options, where an investor leases a property with the option to purchase it later, can also be used to control a distressed property with minimal upfront capital. These creative strategies require a deep understanding of legal implications and careful structuring, often with the help of a real estate attorney. But they can unlock deals that traditional financing cannot. Bidding at foreclosure auctions. Bidding at foreclosure auctions, particularly trustee sales, requires meticulous preparation and a clear strategy to succeed while mitigating risk. Before attending, investors must have completed extensive due diligence on the property, including a title search, and established a maximum bid based on their after-repair value, ARV, and desired profit margin. It is crucial to stick to this maximum bid, as emotional bidding can lead to overpaying for a property with unknown issues. Arrive early to register, understand the auctioneer's specific rules, and observe a few bids to get a feel for the pace and competition. Remember that properties are sold as is, with no opportunity for inspection, making this a high-risk endeavor. Payment at foreclosure auctions is typically required immediately or within a very short time frame, usually in cash or certified funds. Investors must have these funds readily available. Be aware of the redemption period in some states, which allows the previous homeowner to reclaim the property by paying off the debt, even after the auction. While rare, this is a risk to consider. After winning the bid, the investor receives a trustee's deed or certificate of sale. This document transfers ownership, but it's essential to ensure all necessary legal steps are completed to secure a clear title. Successful auction bidding combines thorough research, financial readiness, and disciplined execution. Negotiating with lenders, REOs. Negotiating with lenders for real estate-owned REO properties differs significantly from negotiating with individual sellers. Banks are typically motivated to sell quickly to clear their books, but they are also bureaucratic institutions with established processes. Investors should approach REO negotiations with a clear understanding of the bank's objectives and their own financial limits. Start by submitting a strong, well-supported offer, backed by a comparative market analysis, CMA, and a clear understanding of the property's condition. Banks often list properties at or slightly above market value, expecting offers below asking price, so be prepared to negotiate multiple rounds. When negotiating with lenders, be patient but persistent. Banks often have multiple layers of approval, which can slow down the process. Highlight any property defects or required repairs in your offer to justify a lower price. Offering a quick close, a clean contract with minimal contingencies, and proof of funds can strengthen your position. While banks typically sell as is, they may occasionally be open to minor concessions or repairs, especially if the property has been on the market for an extended period. Building a good relationship with the listing agent, who represents the bank, can also be beneficial, as they can provide insights into the bank's expectations and priorities. Successful REO negotiation requires a strategic, data-driven approach. Exit strategies: flip, rent, or hold. Once a distressed property has been acquired and, if necessary, renovated, investors must determine the most suitable exit strategy to maximize their return on investment. The three primary options are flipping, reselling for a quick profit, renting, holding a long-term rental income, or holding, long-term appreciation without immediate rental. The choice depends on various factors, including market conditions, the investor's financial goals, the property's characteristics, and the amount of capital invested. Each strategy has its own set of advantages and disadvantages, requiring careful consideration and planning to align with your overall investment objectives. Flipping involves renovating the property and selling it quickly for a profit, ideal in strong sellers' markets. This strategy requires accurate renovation cost estimates and a keen understanding of buyer preferences. Renting, on the other hand, focuses on generating passive income and long-term appreciation, suitable for stable rental markets and investors seeking cash flow. This requires property management skills or hiring a professional. Holding a property without immediate rental or sale is less common for distressed properties, but can be viable in rapidly appreciating markets or for future development. A successful exit strategy is not an afterthought. It should be planned even before acquiring the property, guiding your initial offer and renovation decisions.